I am DS Man, and this is a channel dedicated to researching stock trading strategies and using actual data for backtesting. The topic of this video's backtest is, starting from the dot-com bubble in March 2000, we'll compare the final returns and optimal strategies by using dollar cost averaging, DCA, and other investment approaches to consistently invest in SPY, the ETF tracking the S&P 500 index, over a 10-year period. We'll analyze which method ultimately delivered the highest returns and determined the best performing strategy through this decade-long market cycle. Backtesting parameters. Buy and hold strategy. All positions are held until the maturity date, 10-year period, without selling. Monthly investment capacity. $1,000 is allocated each month, but funds accumulate if no buy signal occurs. Adjusted prices. Calculations use adjusted close prices, incorporating dividends and stock splits. Lump sum investment with accumulated funds. When a buy signal triggers, invest all accumulated funds since the last purchase. E.g., if no buy signal for 3 months, invest $3,000 at once. Staggered entry with accumulated funds. When a buy signal triggers, split the total accumulated funds into 2 to 3 parts. Initial investment, 33 to 50% of accumulated funds. Additional investments. Deploy remaining funds if the price drops 10% from the initial entry. Limited to 2 to 3 entries per signal. Dividend reinvestment. Dividends are automatically reinvested on the ex-dividend date. All right, let's break down this table outlining the parameters for our phased investment strategies. Here's what each column means. Times the number of planned investment tranches. Percent of investment. The portion of available funds allocated per tranche. Percent of drop. The price decline required to trigger the next tranche. For example, 2-tranche strategy. Allocate 50% of funds up front. If prices drop 10%, deploy the remaining 50%. 3-tranche strategy. Start with 33% of funds. If prices drop 10%, invest another 33%. On a further 10% decline, deploy the final 34%, adjusted for rounding. These setups simulate how spreading investments across market dips can balance risk and opportunity. Key definitions. MA, moving average smooth price trend indicator over a specified period, e.g., 5 MA equals 5-day average. KD golden cross. A momentum signal where the stochastic oscillator's K-line crosses above the D-line, while K less than 20, oversold condition. Basic strategy, monthly systematic investment. This approach involves executing a buy order every month when the daily closing price falls below one or more of the following short-term moving averages. 5-day MA, 10-day MA, 20-day MA. This systematic method leverages short-term price dips to accumulate positions consistently. Technical strategy, advanced trend and momentum signals. The technical strategy combines long-term moving averages, MA, and KD golden cross conditions for precision. Key scenarios include long-term trend confirmation. Buy when the daily closing price is below long-term MAs, such as 240 MA, for 80 MA, 720 MA, 1200 MA, or 2400 MA. Combined momentum signal. Buy when the closing price is below 240 MA, for 80 MA, or 720 MA, and a KD golden cross is triggered. Trend alignment and momentum. Buy when 5 MA lower 240 MA, indicating short-term weakness relative to long-term trend, and a KD golden cross occurs. Why it works? These strategies blend trend following via MAs with momentum reversal signals via KD to identify high probability entry points. The systematic approach establishes a foundation of disciplined execution, ensuring consistency regardless of market conditions. In contrast, the technical strategy is tactically designed to capitalize on market dips, identifying optimal entry points when prices retreat below key technical levels, thereby aligning investment actions with short-term momentum shifts. Let's dive deeper into real-world examples. Got a strategy to test? Share it below. Example, buy when 10 MA cross for 2 strategies. The top section shows the performance of the optimal strategy, while the bottom section displays the results of dollar cost averaging. A red arrow marks a buy signal, and a green arrow indicates a sell signal. The white line represents the daily closing price, helping us observe market fluctuations. The orange line shows the average cost of the optimal strategy, while the yellow line represents the average cost of dollar cost averaging. These lines allow us to visually compare the cost changes of both strategies in relation to market trends. On the right side, we've listed the top 10 strategies with the highest profits from that day's backtest, along with their profit amounts. This data helps us understand which strategies perform best under specific market conditions and their profit potential. Through this chart, we can clearly see the performance differences between the strategies and their ability to control costs. Hey everyone, welcome back. Today we're diving into our top performing strategy from the dot-com bubble backtest and comparing it to systematic investing, dollar cost averaging. Best strategy, 5 MA lower than 240 MA and KD Golden Cross. Total return, plus 27.8%. Annual return, 3.1%. Sharp ratio, 0.63. Maximum drawdown, minus 35.2%. This strategy effectively times the market using moving averages and momentum indicators. It reduces exposure during downturns and re-enters at favorable points, achieving higher returns than passive investing. However, it requires active management and has higher drawdowns, meaning you'll face larger temporary losses during crashes. Systematic investment, dollar cost averaging, DCA, total return, plus 20.6%. Annual return, 2.1%. Lower risk and simplicity. Maximum drawdown, minus 34.2%. DCA is the set it and forget it approach. Instead of trying to time the market, you invest a fixed amount regularly, reducing the impact of market volatility. While it doesn't maximize returns like active strategies, it smooths out risk and prevents emotional decision-making. Which one should you choose? If you enjoy active trading and can handle higher risk, the Golden Cross strategy might offer better returns. If you prefer a hands-off, stress-free approach, DCA is a consistent and safer way to build long-term wealth. Both strategies have their strengths, so it all depends on your risk tolerance and investment style. Now that we've identified the best performing strategy, let's break down how it actually performed during the dot-com bubble and the years that followed. Strategy overview. Strategy, 5 MA lower than 240 MA and KD Golden Cross. Trades made, 10. Average by price, $66.20. This strategy relies on moving averages and momentum indicators to time entries and exits. It avoids long downtrends and captures profitable rebounds. Performance highlights. Total return, plus 27.8%. Annualized return, 3.1%. Sharp ratio, profit/risk 0.63. Unlike a simple buy and hold approach, this strategy successfully navigates market volatility, leading to better risk-adjusted returns. Key drawdowns and profits. Worst drop, minus 35.2%, October 2002. Best peak, plus 63.8%, October 2007. At its worst, the portfolio was down 35.2%, but by exiting at optimal points, it later achieved a 63.8% profit before the 2008 financial crisis hit. This page provides a closer look at trade execution, showing buy and sell points during different market phases. If you're hooked on seeing real strategies battle historical crashes, like the dot-com bubble or 2008 meltdown, do me a huge favor. Smash like if you want more strategy versus history showdowns. Subscribe. Every new sub fuels deeper dives into technical indicators, basic indicators, and AI-powered backtests. Share this with someone who geeks out on data-driven trading. Your support equals more videos like this. Want to see how a 240 MA plus RSI strategy would have handled 2020's crash? Thanks for watching. See you next backtesting.